WHC. America may be facing its most dangerous debt moment in modern history. Not because of one market crash, not because of one political speech, but because of one number that keeps getting bigger every single day. $39 trillion. That is now the size of America's national debt. And for the first time since the aftermath of World War II, the debt burden has pushed above 120% of GDP. But the real danger is not only the debt itself. The real danger is the interest. Since 2021, the average cost of borrowing has roughly doubled. That means Washington is no longer just borrowing more money. It is paying far more just to carry the debt it already has. Interest payments alone have moved above the $1 trillion a year level. And now comes the pressure point. A massive share of Treasury debt has to be refinanced in the near term. That means old, cheaper debt is being replaced with new, more expensive debt. And this is where Kevin Warsh enters the story. Warsh has now taken over the Federal Reserve at one of the most fragile moments in American financial history. At his confirmation hearing, he signaled what he called a major shift in how the Fed should think about inflation. His argument is simple but controversial. Not every price increase is real inflation. If beef prices rise because of supply problems, that is a price shock. If oil prices rise because of geopolitics, that is a price shock. But in Warsh's view, true inflation happens when too much money is pushed into the financial system, and that money starts chasing too few goods. That is why he wants the Fed to focus less on noisy price spikes and more on trimmed inflation measures, which remove extreme movements from the data. Under one Dallas Fed measure, inflation looks much closer to the Fed's 2% target than traditional core inflation does, and that changes everything. Because if the Fed believes inflation is lower than the public feels in daily life, it could justify cutting interest rates sooner. Lower short-term rates would help the Treasury refinance part of its debt at cheaper levels. With trillions of dollars rolling over, even a small rate cut could save tens of billions. But the deeper story is even more important. If inflation stays higher than interest rates, the government benefits in a hidden way. It repays old debt with dollars that are worth less than before. In simple terms, inflation quietly reduces the real value of debt. That helps the borrower, and the biggest borrower in the world is the United States government. But there is a trade-off. Savers lose purchasing power. Retirees living on fixed income feel the pressure. First-time homebuyers may still face high mortgage rates because long-term rates are controlled by bond markets, not just the Fed. And if investors fear inflation, they demand higher yields. That pushes mortgage rates higher. So Warsh's plan could ease pressure on Washington while making life harder for ordinary Americans without assets. Homeowners with fixed mortgages may benefit. People with fixed-rate debt may benefit. But renters, savers, and young buyers could feel the cost. This is not just a Federal Reserve story. This is a debt story, a currency story, and possibly the beginning of a new financial regime in America.